Hey, welcome back to the Think Bigger Real Estate Show. I'm your host, Justin Stoddard. Very excited about today. You as real estate agents work very hard for your money, right? Most of you, some of you don't. Those that are high producers, those that love this show are very hardworking. And wouldn't it be nice if you could keep more of the money you earn? Number one. And number two, wouldn't it be nice if you had a strategy to be able to differentiate yourself from the typical agent, differentiate yourself from technology disruptors, and give people a reason beyond just liking you as a human being, give them a real value proposition that makes them want to come to you because your commission becomes irrelevant because you're that valuable. Today's topic is going to be all about that. I have with me a true expert, national expert. His name is Toby Mathis. And let me get into his bio here in just a sec, but let me give everybody a reminder that we do a lot of content here on the Think Bigger Real Estate Show, as you know. And I would encourage you, if you've not yet signed up, to get our weekly updates that go through and give you show notes and that also give you highlights and action steps. Go sign up for that at thinkbigger.realestate. All right, back to our guest today. Toby, again, thank you for being on the show today. Super excited to introduce you. So let me just start by saying thank you for being here.
Hey, thanks for having me.
Yeah, this is good stuff, man. So for those that don't know Toby, he is a teacher first and foremost. He said that's the thing that I want people to know first and foremost about me, is that he's a teacher, he's a writer. He's written over 1,000 articles, a number of books. He's a tax lawyer out of Nevada. He and his firm serve on an ongoing basis over 18,000 clients. And at any given time, they're servicing 30 to 50,000 clients because their tax strategies, they understand tax law. They understand the importance of real estate when it comes to tax law. And these guys have some stuff that are going to absolutely blow your mind today. Toby, again, thank you for being on the show. I'm excited to share your knowledge, at least not share all of it because that would take forever, but at least introduce you to the audience and let people know how they can get in contact with you. So appreciate you being here.
Hey, it's fun to get to join you. Usually people don't bring a lawyer into the mix voluntarily. Usually it's got to be beaten over the head. But if you learn how to use them appropriately, they can be quite an asset.
I love it. So you're in, let's kind of get something out of the way here really quickly. This TB stands for Think Bigger. My goal is to help people think bigger. I know when they do, their life gets better. Toby, you're obviously a big thinker. I mean, to have the kind of impact that you're having and service the amount of people that you're servicing. And something I didn't mention, you've got over 150 properties nationwide. So, right, you're in this real estate game, not just from the outside, but from the inside. What is the reason why you do all of that? I mean, what's behind you? Is there family, some sort of like big motivation that's like, I have a driving force to make a big difference in the world because I want to? What does that look like for you?
Yeah, for me, it all comes down to creating a legacy for my family. So when you first get involved in something, you're always looking to say, what kind of impact in the world can I have? So I'm very much into the charities. From a tax lawyer standpoint, I can tell you there's nothing better than tax-free, where you give you can literally, I'll just give you one example. You could literally give a rental property that you've depreciated fully to a charity and write it off all over again. So for some of the high net worth people out there, they're going, what? Yep, I can take 100% fair market value deduction tomorrow if I want to. So once you start realizing that there's laws built around that, it gets to be a lot of fun. And so for me, my driving force is you shouldn't be teaching something that you don't do. I believe that there's nuances to doing things. So if you're in real estate, for example, you better be talking to advisors that actually are in real estate, that you can't learn it out of a book. You learn by doing. So I'm a big believer that I better be doing what my clients are doing because there's what you can do and there's what you should do. And I could get your taxes down to zero. I know that because I'm a tax lawyer. Like there's so many different loopholes or incentives out there. But if I did I just hose your business? Like, how are you going to get a loan? How are you going to grow? And so there's always this stuff where people will go to the accountant, they'll go to the lawyer, and they're teaching it from a philosophical idea or out of a book, but they're not thinking about real world impact. And as a result, I just see there's so much bad information out there that I really enjoy correcting it. And I enjoy watching people just get huge results with very little effort. That's that's rewarding.
Awesome. So that's what's driving these think bigger actions that you have. And this
Mhm.
is the legacy and creating something great for your family, as well as just seeing it, kind of the big difference it makes in the lives of people. I love that, man. Let's kind of go here. What's some of the biggest, and you've kind of already hinted at some of these, but
Mhm.
what are some of the ways that a real estate agent, not even including their own like investment portfolio, right? That's a whole separate topic that maybe we'll go on in a different show. Maybe we'll have time today.
Mhm.
We'll see. But let's say that I'm a real estate agent and I'm earning income. What are some of the biggest mistakes that real estate agents make that
Mhm.
would have an immediate, like make an immediate difference in the amount of taxes that they pay on their
All right.
income?
Let's just increase your take-home pay by 10% on an average agent. So let's just say that the average agent is somewhere between $50,000 and $70,000 a year. What we see is if you implement one small strategy, which is the tax designation for that actual business, you'll increase your take-home pay by about 10%. So if you just want to increase your take-home pay by a few $1,000s, the easiest thing to do is make sure you're not operating on your Schedule C on a 1040. 70% of the agents out there operate as sole proprietors. That's what it's called, because the accountants say, oh, it's easy. It's one of the worst things you could do. If I could, I'm going to approach this from a couple different angles, Justin. Number one, from an audit standpoint, if you are a sole proprietor making, let's say it's $100,000, and I'll just use that throughout, 100 grand, you are 1,200% more likely to be audited than your corporate counterpart.
Wow.
You are also going to lose that audit. And this is from the 2018 IRS data book that they just published out a couple months ago. Like, they'll tell you who they audit and how often they win. They win about 94% of the time, the IRS. So you're 1,200% more likely to be audited. You're going to lose 94% of the time. So why would an accountant put you in that situation? Plus, you're paying about $10,000 a year more in taxes as a sole proprietor. And that's because 100% of your profits are subject to something called old age, death, and survivors and Medicare, commonly known as Social Security. You're getting hit on 100%. Whereas if you just designated yourself an S Corp, you would be able to eliminate about 70% of the money from that, that you make from that designation. You could literally, by a simple piece of paper, change it. Now, here's what gets confusing to agents is they're told that their broker won't pay an S Corp or something like that. There is a workaround from a tax standpoint. So that is partially true from a state standpoint, but from a federal tax standpoint, there's an easy workaround. It's 2 pieces of paper. Just knowing that can put on $100,000 a year, it will put immediately about $10,000 more in your pocket. And that's $10,000, like $10,000 cash, almost $1,000 a month. And that's just the start. The second part is there's something called an accountable plan for reimbursing all of your expenses. As a sole proprietor, you're able to deduct parts of expenses that are business related. If you become an employee of an organization, i.e. an S Corp, you become the employee. Now you can reimburse 100% of your medical, not your medical, you can reimburse 100% of your expenses that are associated that benefit that building, including your cell phones, the actual physical phones, the computers, even a portion of your home that is not a home office that goes on your Schedule C and files a special form. This is actually just a tax-free, hey, here's a check to reimburse you that doesn't get reported on your 1040. So like, there's some simple, easy ways to immediately increase your take-home pay, which is what I do. I spend most of my time figuring out it's not what you make, it's what you keep. Yeah. And for real estate agents, my God, they leave a lot of money on the table. And that's because they're so busy and they're not thinking about keeping it. So it's almost like sand through their hand. They're making a ton, but it's going right through their fingers. And so a lot of what I do is saying, hey, let's keep more of it.
You know, I think not all agents are like this, right? And I believe that the audience that's attracted to what we share here is not that group. But there is a group out there that's very ego-driven, right? And it's more about gross commission. It's more about the car that I drive and the lifestyle that I lead, as opposed to actually building wealth. And no judgment, right? If that's what's important, that's what's important. Great. But I think for me and the group and the tribe of people that I want to be a part of, it's how much you keep, right? It's the impact you make and how much you keep. And so what you're saying here is really resonating, I think, with all of us, is that there are ways that you can go about keeping a lot more. And it doesn't necessarily buy into maybe some of the common held beliefs of right? Being a top producer when you're asked about profitability and you have no answer for it, right? Because that's not your goal. To this audience, this show, profitability and building wealth is the goal, right? So, you're speaking our language. This is fantastic. Okay, great. So be sure and set your business up properly as described. What else are agents missing? And in fact, let's take that concept now, because I want to look at this through two angles. One is, as a real estate agent, the way you're set up can create tax savings for you. What's a way for a real estate agent to be able to then be sure and offer that similar advice to their clients, right? To where it becomes not only a value add to them on their bottom line, their net worth, but also an added value proposition. What's a way for them to bring that up, right, as they're interacting with clients?
Oh, you could actually very easily, for no cost, by the way, add as a service. Hey, let's take a look at the tax impact of your sale. So, for example, let's say that I'm talking to a client in San Francisco. Client bought their house for, let's say, $500,000. Now it's worth $2 million 10 years later. And the knee-jerk reaction is, oh, you'll get to, you don't have to pay tax on capital gains on the sale of your house. But wait, there's a limit to it. Yeah, it's $250,000 for an individual, $500,000 for a married couple. So they bought a house for $500,000. They're selling it for $2 million. There's a $500,000 of capital gain exclusion. So they're going to have $1 million of gain. And you go, oh, it's capital gains. That's great. It's not great. It's 20% for where they're at. And they're going to have net investment income. There's going to be another tax of 3.8, plus there's the state tax. You're at about 37%, which is a pretty significant sum on that $1 million. It's $370,000. What if you could avoid that $370,000? What if you had advice that you could give them that would actually say, hey, if you want to avoid the $370,000, you could do it? What differentiating factor is that going to have over the agents that are just saying, hey, let's list this thing? If you just spoke that in their ear, by the way, you could avoid that. It's actually really easy, and the IRS tells us exactly how to do it. You can combine what's called a 121 exclusion, that 2 out of the 5 year, the $500,000 capital gains exclusion, with a 1031 exchange. You just have to change the nature of the property, and it doesn't take very long, like a few months. And you could literally avoid the entire tax hit if you wanted to. If you're giving them that option, who are they going to start listening to? Hey, this guy's actually looking out for my best interest. That's a huge amount of money, by the way, that they're leaving on the table. It's just knowing those little nuances and knowing enough to say, hey, maybe we should have a look at it. It can have a big impact.
I love what you're saying here, Toby, and we probably ought to share kind of a conversation you and I have had prior, which is the reality that many agents right now are in the crosshairs of technology. I would say all agents are in the crosshairs of technology. And the reason why that is because agents typically have come out of some sort of customer service industry, hospitality industry, and they think like salespeople, right? Like customer service representatives. They aren't thinking like advisors. And technology has been looking at real estate agents saying, if all they do is market a house and sell a house, we can do that. We can write an algorithm for that, or we can have low-paid people help assist us with that. And I think the way that agents are going to remain well paid is simply, it's not because you're going to have a craftier message. It's not because you're going to be trickier in the way that you present at your listing presentation, right? It's you're going to actually have real value. Your commission will become irrelevant as you can have conversations like you just described, in which people are actually allowing their clients to save tens of thousands of dollars, right? Your fees become quickly irrelevant when you have people like Toby in your network and that are pouring into you, into your business, and pouring into your mind so that you can show up and deliver that kind of value. All of a sudden, people like your fee becomes irrelevant, right? Because of the value that you're bringing to them.
You're saying something that I firmly believe. Just because as a tax person, a lot of times they'll go, I can go to H&R Block. Okay, you can pay $500 to get a return done. That's going to cost you an extra $5,000 in taxes. Or you could spend $2,000 on a return that's going to save you $10,000. The net in your pocket in the latter is $8,000 of actual cash in my pocket. The net in the other is a minus $4,500. Yeah. And the wealthiest folks, the most successful people, realize that there's a value. They get more money as a result, which is kind of the kicker, but they're value proposition people. They're not price people. Anybody could say, hey, I'll list your house for 1%. That's, to me, that's crud. Like, I'm going to get what I pay for it. I would much rather get the maximum for my house. And by the way, it's about what I get to keep. And I give you a great example, Justin. There was a property. I think the purchase price, and this is from about 2 years ago, that it sticks in my head because it was about a $1.3 million property. It was a fourplex that they ended up selling for 2.2. They're going through, and somebody's recommending something called a cost segregation. And the individual, the agent involved was like, why would you do that? It's too late. You should have done that when you purchased. And you're like, hold on for a second. Let's actually look at the numbers of what happens when you do a cost segregation right before you sell. And for those who don't know what a cost segregation is, it's when you take a building and you break out the shorter lifespan components from the actual structure itself. So typically in a residence, for example, that's 27.5-year property. The IRS lets you write it off 127.5 every year. That's called depreciation. Well, you can accelerate that. I could take the carpet, for example, and write it off in 5 years. I could take the there's 5, 7, and 15-year property. I could write off the air conditioner. I could write off a bunch of the electric system and things like that. It's things that are hooked up that could be removed from the home. And anyway, so you're able to really rapidly depreciate those. So there's a huge incentive if you're an investor. But at the end of the life of when you're actually selling it, there's still an incentive. And so we did the numbers. It was the difference between paying $280,000 in tax versus $200,000 in tax. That was literally the difference between not doing the cost segregation and doing the cost segregation. So let's just put this in perspective. You're selling about $2 million property. Your commission might be $60,000, something like that. Depending on what, I have to do the math in my head. It's about there's a pretty good chunk of money there that's going away. I guess it's 2 million. It's not 60,000, 6,000. You could actually save them like a multiple of 10 in tax savings just by knowing maybe we should have an analysis done. The cost of doing that cost segregation, by the way, and it's not something we do, it's something we work with other engineers to do. The cost of that's maybe around $2,500. $2,500 saves them $80. Your commission is a small fraction of that. Who are they going to use and refer all their friends to at this point? This agent saved me more than I had to pay them by about 10 times. They're coming back to you.
It really is the future of well-paid real estate agents. Folks, I hope you're listening. Number one, for your own business, but I also hope that you're listening in how you need to start showing up in the marketplace, right? Is that having better photographers, having even a slightly better social media presence, this is all becoming a commodity, right? It's to the client that doesn't move the needle enough to pay somebody this amount when a tech company's offering this amount, right? But yet that delta is irrelevant when it comes to adding in the kind of value that you're talking about here, Toby.
Absolutely.
It becomes irrelevant. Again, the law of value, as described by yesterday's guest, Beth Callan, is the amount of value that you give minus your cost. And that delta right there, as long as that is larger than the difference between you and the low-cost competitors, you're fine, right? As long as you can provide that and then articulate it, communicate it to where people understand it, you're in good shape, right? The sky is not falling for agents that can think intelligently and move forward with knowledge, right? We're in the knowledge economy, and having superior knowledge wins, right?
Yep, absolutely. I'm just going to reiterate what you're saying. I work with agents that make strong 7 figures all day long, and the difference, like they're providing essentially the same service as far as selling the house. It's all the added knowledge that they have that they bring to the table. And I can tell you one thing, just my experience from doing this for a few decades now. Gosh, it's going on 3 now. The people that focus on price tend to be the ones that limit themselves. The people that focus on value are the people that explode and just have huge growth. And that goes for yourself. And it's hard because it's kind of like learning a golf swing. Feels uncomfortable because, like, I guess people that spend a lot of money on photography and things like that. I have clients that do that stuff too. And they're always telling me staging and photography on the right property. Obviously, it has to be a value proposition. It has to give you something back, but they're not worried about the price of it. What they're worried about is how much is it going to increase the value of the home and the sale price of the home and how quickly and how many offers they get. They're focused on that. They're not looking at it. Oh my God, that was $1,000 that I could have kept in my pocket. No, they're looking at the long game. I'm going to have people that love me. They're going to tell me all their friends. I'm going to be top of the market. I'm going to be getting the most dollars per foot out there. And these people are going to keep coming back to me and they're going to send everybody else. If you ever get into an investor where you're working with an investor, they will just keep using you because you are bringing them far more value than anybody else. Absolutely, 100%. I can tell you that from experience because I do the exact same thing.
Well, and I think, and I agree with you. And I also agree that those things are becoming more and more common, right? Having great photography, having drone photography used to be a real differentiator. And now it's the standard. Now you need to have, have to have that. And I think having the strategies in your mind and or the people in your network like you, right, or the knowledge that you bring as an example becomes a real differentiator because most agents are not having those conversations, right? They're there to market a house. They're there to offer great customer service.
Yep.
They're not there to say, let's look at this differently. Let me introduce one of my experts who can really see from a tax standpoint the best way to go about this, right? Enter expert, exit, significant difference in return, tax savings, depreciation, whatever it might be. And all of a sudden, like you look and sound very different than the typical agent.
And Justin, just to dovetail on that, it's so easy to say, let's do a quick tax analysis. We'll do it for free. That's all you have to say is, hey, as part of my service as an agent, I'm going to look and see whether we can save you any money. It only takes one. If you just walked up to one person and said, you know what? We did this one thing right before we sold it, and it saved them $40,000. That goes a long way. It's like, hey, we're going to see if that's you. People just instinctually are like, yeah, I want to know that. What did you do? Well, sign first. we'll share with you what we do. At the end of the day, we want you to have more money than what it costs to pay for us. And it's like you said, that value delta. Most agents, there's no value delta.
So what I hear you saying is that agents ought to be including that into their presentation, right? Is that if you sign with me, we do a free tax evaluation to make sure that the proceeds of this property are maximized.
If it's real easy. So like if you're just selling single family house, person's been living in it, the rule is 2 out of the last 5 years they had to have lived in it and owned it. So, so if somebody gets married right before they sell it, they don't meet the test, right? Yeah. They may own it at the time that they sell it, but they didn't live in it for 2 years, both spouses. So you're going to have either 250 or 500,000. So if you're just dealing with houses in that range, you could learn that and you could be pretty potent. And most people actually know some of those things and they're looking for it. So they may know. Where it really becomes valuable is when you're going into the $1 million plus houses. Now you have a huge differentiating factor. And I don't know about you, but I think I'd rather be selling some of the higher end properties. Some people really love the stuff that's cheaper. Fantastic. But where the real value delta comes into play is when you understand that there are ways to avoid the taxation or to convert something into a different category to where you're able to jump up the depreciation. Right? And a perfect example is if you have a house and you're going to make it into a rental because you're moving out. Most people would just do that. But if it's appreciated, you should sell it, capture the 121 exclusion, but you could sell it to a related entity. You can actually sell it to your own business that then now has an increased depreciation. So now you're not paying tax on the rents, and all you did was literally sell it to yourself or to an artificial person called an entity, like an LLC, taxes and S corp or something like that. You're literally jumping up the depreciation level, the value of that house, and you're grabbing your capital gains exclusion at the same time. Perfectly legal, really smart, but most, probably 9 out of 10 people don't do it. And it's insane. You're looking at it saying you've been living in the house for 20 years. It's worth a ton more than what you paid for it. You may as well get the benefit of that. Why wouldn't you harvest that? And most people just don't know.
And financing from an entity, they don't look at the entity in and of itself to see if the entity can purchase that home. They're still looking at the principles of that entity, correct? Yeah.
What you look at whenever you're doing lending is cash, collateral, or credibility. So the credibility of an entity that hasn't been around, they're looking at the owner, unless it has a bunch of cash. Now, here's the beautiful part. That transaction I just described is where you take a house. Let's say you bought the house for $100,000 and now it's worth $400,000. If I just made that into a rental because I'm going to buy a new house, whatever, and I'm going to keep it, I'm going to make it into a rental property, which is smart. My depreciation would be based on the $100,000 purchase price. The improved value would be what you depreciate. But if I sell it to my own S corp at $400,000 and I carry back the note, I actually do an installment sale. I could literally pay myself out of the rents tax free. Because as that rent comes in, it's being offset by this new increased basis of $400,000. Now my improvement value might be $330,000. I'm getting over $10,000 a year in deduction to offset any rents that I get. It's going to be quite literally you're quadrupling the amount of depreciation. And if that's not enough, we'll do a cost segregation on it and we'll get an immediate, get this, on that house, it's about a $90,000 deduction in year one because of bonus depreciation. And I'm not kidding you, that $90,000 could offset their income depending on whether they qualify as a real estate professional. For a lot of the agents, they it's almost goes without saying, they automatically qualify. But it's pretty potent stuff and it doesn't take much to learn it. And now all of a sudden you're like, whoa.
So what I heard you say is that you can sell a property that, let's say my wife and I own, I can sell it to my entity and I carry the note to where there's actually not a traditional lender in place.
Correct. You can actually do what's called an installment sale. You make an election on your tax return to treat it as an installment sale. So I sell it for, let's say I sell it for $300,000 as an example. You would calculate out what the interest would be. You should use what we use is federal AFR rates, which is about 3%, a little bit less than 3% right now. You go and use the federal long-term interest rate so you know its market value, and your entity pays you that interest. That's okay. It's deductible to the entity and it flows onto your return anyway. It's like you're not actually paying tax on it. What you're looking at is how much rent you're able to calculate, and it's being offset by that increased depreciation. So you're literally getting cash and not paying tax on it. That's all. Otherwise, if it was the $100,000, I'm depreciating such a small amount, I'm having to pay tax every year on all that rent. Well, it goes into my highest tax bracket. Right. So for some people, they're like, they're giving away a third of it or more. Yeah. You're like, I don't want it. This stinks. So let's just sell the house. That's the mentality. They're like, I don't really want to, let's just get rid of it. I don't want to have the headache. If I could get an extra $10,000 or $12,000 a year tax-free, I would take it.
Yeah. Right. Folks, I hope this is illustrative of a couple of things. Number one, that Toby's an expert, right? I would venture to say that few of you were aware of this. I know I wasn't. I've never heard this taught. Maybe some of the more savvy agents and investors are very aware of this. But needless to say, you need to be surrounded with this kind of knowledge for your own good, as well as, again, think about the differentiator just by reiterating some of what Toby's speaking here to your clients, taking this snapshot, going back and listening to it again and again, and going and restating that in your next listing appointment. How much different are you, right? And then tune in to Toby. Find Toby. He does, what's your ongoing sales talk stuff, Toby?
Oh, I got to tell you. So we teach for a lot of large organizations out there. I won't get into them, but I love to teach. That's why I say the first thing I am is a teacher. An easy way to go is if you go to our website, every other Tuesday, I do something called Tax Tuesdays. Tax Tuesdays is a free-for-all. You can ask any tax question you want. No cost, no obligation. You're not going to get hit. You're just going to go on, and we have about 5,000 people that are registered on a biweekly basis, and all we do is a bunch of them are accountants, so it's kind of fun. Every now and again, I get stumped, and I have a 30-year accountant, CPA that does it with me. So we're always sitting there, and usually we'll know the answer. We've heard all these things before, but every now and again I get stumped. And what's fun is you'll have 10 CPAs out there doing the research for you, shooting it over, like saying, hey, here's the answer. So, I didn't realize that notary fees weren't were exempt from Social Security taxes. So I was like, wow. So it was a notary. I was like, hey, if you're a notary, I guess, hey, you don't have to pay the self-employment tax. Make sure you know that. It saves you. It's a pretty big chunk. It's 12.4% old age and survivors and 2.9 Medicare. That's going to save you a little bit of money. Yeah, it's about 15%. So it's like, hey, let's save that. Just go on to it. And usually you're pretty shocked. I do make it into a podcast too. I'm not going to compete with your podcast, but we do make it to where you can listen to them later if you feel like it. Tax knowledge is one of those things where you get a little bit of it and it goes a long ways. Yeah.
But this is golden stuff. Toby, again, there's no way we have time to go through everything that but hopefully we've at least pointed people to the source where they can go get more, where they can follow you and be taking these tips and bringing them into your everyday conversations, being sure that you're applying them in your own life and business. It's just a much better way to work that further insulates you from everything that's happening out there. Toby, I want to ask you this question as we wrap up here. Well, first and foremost, is there any other strategies that are top of mind that you really wanted to share today that we missed, or are you feeling pretty good?
There are so many out there.
I know, that's a problem.
I don't know where to hit it.
By asking that question.
Well, here's a fun one. If and just kind of if you're a socially conscious person and you want to put some solar on your house, just know that you get a tax credit for the solar, and you can still depreciate it if you put it into service on like a rental property. So you're kind of double dipping there. The depreciation isn't quite 100%; it's 85%, but you're getting a tax credit, which is basically you're getting a huge chunk, 30%. That's a tax credit, not a deduction. A credit. It's like getting money back in your pocket. So you put a $20,000 solar array, you're getting $6,000 off of it. So you're really spending 14, but now you're going to depreciate the $20,000. It's actually 85. So $17,000 immediate depreciation. So for some people, it makes a huge difference. They all of a sudden don't have to pay tax on their rents. And they're like, wait a second, I just wiped out all my tax hit, and I'm going to have solar arrays on my rental property forever. So like there's little things like that, but there's so many of them. I can't even begin to start. And if you're an agent, have your own solo 401k. You can defer the first 19.5 directly into it. If you're over 50, it's 26,000. You can put a ton of money into these things and not pay tax on it as it goes in. Yeah. And if you still want to invest in real estate, that 401k money, you could actually buy real estate in it, or you could borrow out 50% of it and use it on. Yep, you could absolutely. There's so many little nuances.
And I can tell you, you've got your arms around what agents need to know. This has been fantastic, Toby. Let me ask this final question, which is the signature question of the show, which is, you're obviously a big thinker. All right, you're doing some incredible things, not just with your immediate clients, but now spreading it to a wider and wider audience. What does Toby do to continue to be a big thinker, to continue to expand your own possibilities? What does that look like for you? Teach us.
All right, I'll make it real easy. I'm a big believer in a guy named Andrew Carnegie, who wrote something called The Gospel of Wealth in 1899. He was the richest man at the time, and he basically said that there's nothing wrong with being rich. Just make sure you're giving back. And the way he put it is, millionaires are trustees of the poor. You cannot fill up somebody's glass with water from an empty pitcher. So you owe it to yourself and to those around you that if you're good at something, do a lot of it. Don't stop. Like, I could have retired a while ago. Don't stop. There's no such thing. Continue to create wealth, because some people are really bad at it. The truth is some people just aren't good at making money. So if you're really good at it, make it, and then make sure you're giving back. And there's so many ways that could take place. Do you know that low to moderate income housing is actually a nonprofit activity? Like, yeah, you could literally do this and not pay tax at all, not even property taxes. So there's just so many little nuances out there. Once you start making it, there's so many cool ways that you can do just amazing things for society, for other people. And frankly, it's so much fun to do it. It just gets really exciting once you're no longer worried about putting food on the table. You're thinking about somebody else's putting food on their table. And it just changes your whole outlook on life.
I can see why there's some people that get wealthy, right? They've got a mentality like you do, is that I'm going to do it not to necessarily build another statue of myself, but because there's other people out there that are needful of my abundance, and I'm happy to create so that I can share. It's good stuff, man. You've been such a valuable contributor. Again, let's tell people where they should go. In fact, we'll put it in the show notes, how you can get in contact with Toby, get access to more of his stuff. I know he's got some other resources that'll be really valuable for you as agents as you move from salesperson to advisor and create a better return for yourself in keeping more of your money, as well as differentiating yourself in the marketplace. So final request to all of us is to go think bigger. Hey, I appreciate it, Toby. Total pleasure having you on. Thanks everybody for tuning in today. It's been fantastic.
Tons of fun, Justin. Thanks for having me, man.